In recent years, throughout Latin America, the political barometer has swung to the left. Elections have delivered victory for presidential candidates who seek reform of the economic principles which have for the past quarter of a century been at the heart of globalisation.
Aquí en América Latina no podemos aceptar, la ley del garrote.
Here in Latin America, we can't continue to be colonies of the United States, countries dependent on Washington or the IMF. We have to be free. Our vision of the economy is a caring economy, an economy where the state has to be the fundamental engine, not the market.
Some countries which have not experienced a rising living standard for the masses now doubt the moral basis of the modern capitalist model.
We truly love the president because he governs for the poor.
In this film, we examine some of the key principles at the core of global economics and assess their impact on developing nations. For some economists, the essence of globalisation is a process of delocalisation, the scattering of manufacturing processes across the globe. Globalisation is certainly characterised by the enormous expansion of multinational corporations and their investments in foreign lands. But the term globalisation can be emotionally charged. For some, it means ruthless exploitation by corporations. Yet for others, globalisation means bringing economic development to the peoples of the world. For Mark, a labourer on the Sunripe organic farm in Kenya, globalisation means he has some money trickling in.
What I can say is that finding work in Kenya is not easy, so we appreciate what we have.
The economic processes of globalisation can be split into two broad categories: free trade and financial globalisation. Free trade means a nation opens up its markets to imports, increases its exports, and reduces or eliminates tariffs. Free trade has the potential for creating real economic growth by drawing resources into industries where the country has a comparative advantage. There are many nations where such gains have been seen over recent decades, such as China, India, Brazil, Chile, and South Korea. Financial globalisation, on the other hand, is the global trade in currencies and investments in foreign stock markets and in foreign currency projects. Before the East Asian financial crisis of 1997 to 98, freeing up capital markets was seen as necessary for poor nations to attract foreign direct investment, FDI. FDI usually involves investments in real assets, such as factories. In contrast, financial trading does nothing to increase the productivity of the nation affected. In particular, foreign portfolio investment, FPI, short-term speculation based on the value of a nation's currency, cannot be used to build an industry or create jobs. When investors pull a large amount of such capital out of an economy in trouble, it can wreck that economy and allow a financial crisis in one country to ricochet to another. The 1980s saw the rise of the most radical free market economic policies ever implemented. These so-called neoliberal policies, in economic parlance liberal means free from government interference, stressed free trade and the unhindered flow of capital, with minimal government spending, taxation and regulation. Neoliberal principles are still at the heart of global lending institutions, especially the International Monetary Fund, IMF. The IMF was set up to give financial aid to countries in serious economic difficulty, using funds from its 185 member countries.
An economic collapse can have terrible effects, and you can't prove that the IMF has been a buffer against economic collapse, but I think it has.
But some economists blame the policies of institutions like the IMF for exacerbating crises. One of the main problems of the IMF approach is that fundamental economic changes are introduced all at once, before supportive legal and social frameworks are in place. We'll examine what the lack of these frameworks meant for East Asia, Bolivia and Russia. We'll also look at how China developed its own safeguards against some of the social dislocations arising from the rapid implementation of free market policies. By the early 1990s, East Asia had been so wildly successful at liberalising its economies, its growth had become known as the East Asian miracle. Yet by 1997, East Asia would experience the worst economic downturn the world had known since the 1930s. It underlined the contagion that's inherent in uncontrolled globalisation. Before the 1990s, Thailand had strict controls on how much money banks could lend for real estate investment. Then, Thailand gave in to the IMF demands and rescinded these regulations. Skyscrapers sprouted like mushrooms after a monsoon rain. Soon, capacity was reached and builders defaulted on their loans. The housing bubble burst. In 1997, foreign investors panicked and withdrew their funds from Thailand. The baht plummeted, the Thai stock market crashed, and the economy collapsed.
International capital mobility can be destabilising if it goes into countries whose financial systems are really not very well developed. And that's what happened in the Asian financial crisis.
South Korea had grown since the 1950s, essentially without foreign investment, because it used the savings of its citizens to finance growth. As in Thailand, the IMF and US Treasury put pressure on South Korea to deregulate its financial sector to permit foreign investment. By the mid-1990s, South Korean firms began to borrow heavily from US banks. But in late 1997, rumours began to circulate on Wall Street that South Korea was in financial trouble. Entirely unfounded, the rumours became a self-fulfilling prophecy as capital flew out of Korea. As soon as foreign banks cut off credit to South Korea and Thailand devalued its currency, the contagion spread to other East Asian nations. Losses from investments, defaults, and contracting trade brought Thailand's neighbours down with it. In response, the IMF put together a bailout loan of about $95 billion, in theory, to back the Thai currency with sufficient dollar reserves and stabilise the exchange rate. However, most of the loan was used to service Thai debt to foreign banks.
Of course, these packages end up, to some extent, rescuing private lenders from the consequences of their own actions.
The loans also came with conditionalities, raising interest rates, draconian cutbacks in government spending, and increasing taxes. By 1998, the disease had spread to Wall Street, and the New York Stock Exchange nosedived, as did exchanges in Europe and other parts of the world. Only after riots erupted in Indonesia did the IMF allocate money for food and lift the ban on government help to the poor.
It used to be that if you had the IMF program, you had the seal of approval, markets would always react positively. That's not the case anymore.
The IMF's policies both initiated the East Asian crisis, by forcing capital market liberalisation and exacerbated it by enforcing policies which worsened the situation. The crisis shook confidence in the IMF itself and supported the case that economic globalisation has actually increased international instability. When the Soviet Union collapsed in 1991, Russia began moving from a planned economy where production was owned and controlled by the communist state to a more open, free market economy. President Boris Yeltsin announced that Russia would proceed with shock therapy, radical, market-orientated reform as recommended by the US and IMF. However, this policy resulted in economic collapse in Russia, with millions being plunged into poverty. The privatisation of industry resulted in massive asset stripping, and the lack of regulation of the financial sector was a recipe for monumental theft.
The notion that you might have, out of the blue, out of this communist period, a government system that effectively regulates the banks, and at the same time banks that behave in ways that are acceptable by Western norms, was mad, absolutely mad.
Between 1992 and 94, more than 3/4 of Russia's industries were privatised before a proper tax system could be implemented. In many cases, they were sold to factory or bank managers who stripped their assets and sent the wealth overseas. Russia defaulted on its IMF debt and devalued the ruble. Oligarchs stole billions in IMF bailout money. This modest building in Nauru, in the Pacific, became a licensing agent for around 400 Russian banks. In 1998 alone, more than $70 billion exited Russia via this building.
These are banks that are set up to launder money, and so they're money laundering platforms rather than the institutions to serve society.
In 1989, only 2% of Russians lived below the poverty line. By 1998, it was a quarter.
During the Khrushchev era, you turned on the TV and the first picture would be a tractor moving across a field. It made you feel so good because you knew the harvest was just about to start. But now when you turn on the TV, the only news you see is about bankruptcy and financial operations.
What happened in Russia demonstrated that across the global economy, legitimate and illegitimate streams of wealth proceed as if along two rails of the same track.
The ships, the electronics, the communication systems, the telephone systems, the banking systems, they move a ton of goods and services every day, many, many tons, that serve the billions of people on this earth. But there is a dark side, and there's illicit stuff moving through the same network without barriers.
Russia's economy is now growing. It's using oil to raise itself out of the economic black hole. But it has not yet regained the economic strength it had before communism collapsed. Like the IMF, the World Bank's stated aim is poverty reduction. It works in areas as diverse as building infrastructure and financial systems, tackling corruption and post-conflict rehabilitation. In Burundi, for example, the World Bank oversaw the creation of a united army. But some critics claim the bank has imposed neoliberal principles on developing countries, which have been destructive and anti-developmental, such as the privatisation of strategically vital national resources. The poorest country in Latin America, Bolivia, became even more impoverished in the 1990s after a disastrous program of privatisation imposed by the World Bank and the IMF. In 1999, the Bolivian government tried to privatise the water system of Cochabamba, the third largest city in Bolivia, to help finance a huge dam. In this community, water was already expensive, and everyone knew the price would rise even further.
If I work, thank God I have a little money, but some people here don't have any. They can't even buy a jug of water. That's how extreme the poverty is here.
When Cochabamba's water system was privatised, most households saw their water bills rise from $5 a month to more than $20. It became illegal to dig a well or even to collect rain in a barrel. The outraged people erupted. After more than 3 months of protests, the government gave in and returned the water system to the people's control. It was a disastrous experiment in privatising a basic resource for profit. But now the people, once again, owned the rain. Bolivian President Evo Morales was later elected on a promise to give indigenous people a greater share in the nation's natural resource wealth. In 2006, he nationalised the country's gas industry.
What we need is investment money to explore and to exploit, to industrialise. That's what we need. We need partners, not bosses, not owners of our natural resources.
His actions turned his country's back on the neoliberal principles that had failed the Bolivian masses and set what many multinational companies saw as a very dangerous precedent. China is on track to become the world's largest and most successful economy. The trappings of newfound wealth are everywhere. The wine and ski industries have boomed here in the past decade. Most of China's growth comes from its exports and an abundance of low-wage labour. Because China's communist government controls the economy, it could undertake gradual market reform, homegrown rather than neoliberal economics. China proves the theory that trade liberalisation has the most positive impact on countries entering the global fray from a strongly protectionist economy. With Mao Zedong's death in 1976, China realised that his socialist central planning was no longer sustainable. Moderate communist leader Deng Xiaoping began to reform agriculture. Farmers could sell crops in excess of their government quota on the open market and keep the profits. In the early 1980s, China turned to reforming its industries. Slowly, state-subsidised prices were phased out without inflation or wiping out people's savings. When the East Asian financial crisis hit, the Chinese government poured $1.2 trillion into infrastructure projects to stave off unemployment. Over the last 20 years, more than 150 million people have been lifted out of absolute poverty. For most, this economic miracle has been an undeniable achievement of communist China. But the way reform was implemented has created a deeply troubled society.
Some entrepreneurs simply seek economic profits. They only want to pursue economic development and neglect the protection of workers.
Chinese cities are crammed with 150 million migrant workers, more than 10% of the population, who've left the impoverished West for the more prosperous East.
I feel very bad that we leave our children behind. It's unbearable.
China's remarkable economic growth has many in the US worried. The US has a huge deficit. China has vast currency reserves. The US has an enormous trade deficit. China has a massive trade surplus.
Ladies and gentlemen,
While the US has traditionally believed that most government interference in the economy is anathema, the Chinese government has been proactive in guiding and growing the world's most dynamic economy, ensuring profits accrue to Chinese businesses.
They're able to say, you need our market so badly that this is the arrangement. You can come in, you can bring your money and your capital, but oh, by the way, you can only own up to 50%. And in the same city, my other partner will be your competitor. Deal?
Welcome to Real Estate Auctions, California style. On this day, houses are being knocked down for 40% less than their owners paid for them just a few months ago. The slowdown in the US economy, which began in 2007, has once again emphasised the contagious interconnections of globalisation, both in terms of trade and capital markets, but on a scale that could dwarf the East Asia crisis.
The last time that we saw a home price fall as big as the one we have just seen is 1941. And it's surprising. That was the year the U.S. entered World War II.
The so-called subprime mortgage crisis caused scores of American families to lose their homes. It also sent world stock markets into a spin, caused panic in credit markets so banks were afraid to lend to each other, and forced central banks to pump hundreds of billions of dollars into the system to stop it from seizing up.
The analogy I always use is like a car engine. Credit is the actual oil in the engine. Now there's a big crack and the oil's all flowing out of the engine, so the whole engine is seizing up.
After the World Trade Center collapsed, the US Federal Reserve cut interest rates over the next 2 years to 1% to lift the economy out of recession. With all this cheap money to lend, America's banks were desperate for customers, and so $1.3 trillion was lent in subprime loans, given to people who wouldn't normally get credit, with whopping interest rates, often up to 16%.
In the modern capital market, risk is diffused, it's everywhere. Different investors hold different pieces of the risk, and we don't often understand the linkages fully.
The big Wall Street banks put up the massive amounts of money that fueled the huge lending surge, and then sold the debt to investors all around the world. But some linkages started to become clear when hedge funds, which took big bets on subprime loans, began to vaporise. Worried about their home being worth less than their mortgage, Americans began tightening their purse strings.
Now, the U.S. consumer has been not just driving our economy, but driving those of many others, and also some of the contagions in our debt instruments are infecting others as well.
The U.S. owes more money to more countries than any other nation on Earth. The US also has a huge trade deficit. By its own and IMF standards, the US fiscal house is in serious disarray.
85% of capital flows from Europe, the Middle East, and the Far East is in to the US. And a good chunk of that has gone into the subprime mortgage area, or the mortgage area in general. It's like the old saying about chaos theory. The flapping of the wings of a butterfly in the Amazon causes a Caribbean hurricane. And that's what we're seeing now.
I have to leave now for Shanghai.
Where is Dad off to?
He's going to earn money.
The credit crunch that began in 2007 forced the US, among others, to invest directly in banks for the first time since the 1930s. It became clear that the market had long been under-regulated, and calls for a new banking system where responsibility and stability were valued above risk-taking and profit echoed around the globe.